If you are in the market to purchase a home, you should be wondering who pays for closing costs and how it works. Typically, buyers and sellers each pay their own closing costs. Oddly enough, it can change by county, by tradition, not rules. This is Selland with Signet Mortgage, and I am here today to talk through the closing costs associated with buying a home. Buyer's closing costs. These are costs that go above what you are paying for your down payment, so we need to be careful. Closing costs are your out-of-pocket fees used for items like getting your home loan, having the house appraised, getting title transferred into your name, and so on. Your closing costs can range between 2 and as much as 5% of your loan amount. This means if you're taking out a $600,000 mortgage loan, closing costs could range from $12,000 to $30,000. So the amount that a homeowner has to buy in closing costs can vary a lot depending on the home price, location, and other factors. Typical closing costs paid by the buyer include the origination fee, which is the origination fee for your mortgage lender used to set up and process your application and you verify your documents, underwrite and close the loan, etc. Appraisal fee is the fee you have to have your home appraised. Title search and title insurance. A title search ensures that your new home's title is clear and no one else can claim rights to your home or the property. Title insurance provides protection against undiscovered claims. Upfront mortgage insurance or funding fees. Some home loans require an upfront fee to insure or guarantee the mortgage. Government-backed home loans like FHA, VA, USDA all have an upfront fee, although you can roll this fee into the loan instead of paying it at closing. Discount points let you buy a lower interest rate by paying an extra fee at closing. Escrow is set up so that you can prepay money that will be placed in an escrow account and dispersed as necessary to pay for your property taxes and homeowner's insurance. You will also have your down payment due at closing. So this impacts cash to close, but is not a closing cost. You're paying for a portion of the purchase price to the seller. Any earnest money you paid when you made an offer on the house will be credited towards your down payment at closing. The type of mortgage you choose can also have a big effect on your closing costs, and the biggest of these is mortgage insurance. Mortgage insurance, or MI, is only paid when you put less than 20% down to buy the home. Most mortgage insurance is paid with your monthly payment and considered an annual payment paid monthly. However, there are some loans programs that also have an initial mortgage insurance premium up front, and it will be due as closing or added to the loan. Let's look in detail at some of these types of programs with the upfront mortgage insurance. The first program is FHA home loans, which require monthly mortgage insurance and an upfront mortgage insurance fee. The upfront mortgage insurance premium is equal to 1.75% of the loan amount, or $1,750 for every $100,000 borrowed. FHA mortgage insurance doesn't have to be paid with closing. It can roll into the cost of the loan rather than pay it with cash. But keep in mind, rolling upfront mortgage insurance will decrease your closing costs, but it does mean you'll pay interest on that fee over the life of your home loan. A VA loan has a funding fee. They don't have annual mortgage insurance, but they do require a one-time funding fee due at closing. For first-time home buyers, the VA funding fee is usually equal to about 2.3% of the loan amount. Buyers who have used a VA loan before will pay a higher 3.6% of their loan amount. If you make a down payment of 5% or more, the VA funding fee is reduced. And if you have a service-related disability, the funding fee can be waived. VA home loan buyers also have the option to roll this fee into their loan amount instead of paying it along with their closing costs. Sometimes it's worthwhile to ask the seller to provide a credit towards closing costs rather than a reduction in price. Sure, you pay a little more for the house, but if cash to close is the critical factor, it's a way to get there. It's important to be aware of all the costs associated with buying a home so that you have enough money to pay your closing costs. And if you're not sure, check with your lender. They will be able to cover, talk about your closing costs and your options. There are several costs to be aware of when buying a home, but the greatest news is that our team is here to help you throughout the process. Thanks for watching. This is Clay Selland with Signet Mortgage, and if you or someone you know is looking to buy or refinance a home, or just get questions answered, please reach out to me at the email and phone number and all that at the bottom, and I'd be happy to help. I look forward to helping you get into the home of your dreams. You take care.